Okay, good morning, everyone. Welcome to today's webinar. Today we will be giving an update on Singapore as well as India's macro and on SodaStream. We will also be highlighting deep value opportunity on Perennial, and my colleague Ben will be also be taking you through the offshore and marine sector. Oh, okay. So without further ado, let's start off with the Singapore macro. Okay, for Singapore, we can see that GDP actually slowed sharply last quarter due to a pronounced retraction in our manufacturing sector. Nevertheless, we can see that actually the GDP is stabilizing at around this range, while September PMIs rebound on a revival of new export orders after a mild contraction in August. We can also see that exports continue to outpace imports, and trade surplus continue is uptrend. And from here, right, we can see that actually we can see that there's a shift towards higher value services related activities in particular in the research and design sectors, from the indicator or from the PMIs as well, in particular in the industrial production indicator, which sorry, I don't have the chart here, but as you can see that from Nordex here, and the exports, which are more labor intensive, are not going up as much as what we can see from the PMIs here. Nevertheless, we are expecting that the Nordex will benefit from the global cyclical recovery, which we can see from here. There's an uptick. So for Singapore, we actually downgraded it from overweight to neutral weight on the back of these few headwinds, in particular the capacity constraints on rising rentals costs as well as the labor shortage due to the domestic restructuring that from our local government to slow inflow of foreign workers, boost productivity as well as to attract new industries. We are expecting that these few factors could continue to weigh on Singapore's economy. Then we also see there's external headwinds, in particular to the financial market volatility as well as geopolitical risks, and also the spillover effects from the ongoing policy adjustment in China. So basically, in near term, we may also see in Singapore's economy, we may see that small players that lack of economies of scale to compete, they might be relocating to somewhere else with cheaper costs, or they may be absorbed by those companies with such capacity. So constraints from supply side arising from this domestic restructuring will continue to weigh on Singapore's economy, and it may erode into some companies' margins and earnings, hence limiting the extent of cyclical upturn. However, barring from any significant external shocks, we expect that the STIs will continue its upward trajectory. And to invest in Singapore, you may consider these few mutual funds and ETFs which proxy Singapore. So with this, I would like to pass on the presentation to my colleague Sam, who will be updating on the India macro.
Morning everyone. Okay, so I'll start with India. Okay, India, we still maintain our overweight. We went overweight, I think, around April to May period, and since then the Indian market has actually rallied a lot. And even for now, we maintain the overweight, and the reasons will be because India is poised to continue grow at a pace of 4.8%. Last quarter, it grew at a pace of 4.6% year-to-year change. Growth in India's economy was mostly spurred by the pickup in the agriculture sector. We all know that Indian economy is highly based on the agriculture sector. It's an agriculture-based country, uh, to be more precise. Manufacturing, mining, and construction sector performed below expectation, and that is something the government is taking very serious right now, and that I will probably discuss in the structural policy changes as well. Inflation has been trending down, but there is somewhat upward pressure on wholesale price inflation, which is still on a higher end. Recently, the government imposed export restrictions on certain farm commodities and ordered a crackdown on food hoarding to control rising food prices. Because within inflation, the food price inflation is the more substantial one. The current account deficit narrowed to 0.3% last quarter, and the imports have remained below expectations as well. You can see on the right hand side, the second chart, it shows the trending down sign on the WPI index. Okay. FIIs have turned bullish on India again, and we can see it by the fact that the Indian market rallied more than 25% year to date. And you can see that on the second chart on the right hand side. Then the Sensex index has gone up to like 27,000 plus level since January, which was around like 20,000 at that time. Government taking measures to improve FDI in various sectors, such as in defense sector, in infrastructure sector, where they have increased the FDI limit to 100%, which is a good sign for the foreign investors as well. Equity market-wise, Indian equity market has continued to rally and has managed to garner returns of around 25%, like I said. Forward PE ratio-wise, market is still trading at 17.08, which is still below its long-term average of 18.05. Indian rupee bond maybe outperform other regional bonds, and we still believe that the Indian rupee might appreciate a little by the end of the year. Okay, the last three bullet points, the fiscal budget policy, structural policy, and monetary policy, I'll just be very quick on that. The fiscal and budget policy, there's a move towards consolidation. The inefficient policies and high subsidies caused the gross fiscal deficit to spiral from 2.5% of GDP in 2008 to around 4.6% of GDP in 2013, and that was something, or maybe the main reason why the Congress couldn't win the election, because they couldn't contain the fiscal deficit. The first step which Modi's new government took since after the election was to restore the country's financial discipline and self-confidence. The government has shown quite an urgency to deliver its top 10 policy priorities within 2 weeks of its inception. On the structural policy is mostly investment driven. So like I said, in coming months the government will likely focus on reviving the manufacturing sector, which has slumped in recent months. The central government would work closely with state governments to tackle issues such as land acquisitions and tariffs in the power structure. The structural reforms such as rolling out goods and services tax and infrastructure improvements for industries may be other steps to boost investment cycle. On the monetary policy side, we still hope that it will get loosened on hopes that the inflation will continue to decrease, which will help the RBI to be more loose on their monetary side. RBI right now remains determined to continue its war against inflation and has decided to leave the policy rates unchanged for now, but as like I said, they might reduce it in near future. On the other hand, the statutory liquidity ratio of scheduled commercial banks was cut by 50 basis points, which will likely improve bank lending to investments. So technically, structural policies, fiscal policy, monetary policies, all three policies will combine together help Indian economy to continue its progress for at least for next few years. In the end, we got few unit trusts in ETFs. Let's sit down that proxy Indian market for you to take note. With that, I will pass this on to my colleague Ken.
Hi, just a quick update on SodaStream. So SodaStream we're still awaiting their third quarter results, but in the meantime, a couple of days ago, SodaStream basically just announced a brief profit warning for the third quarter 14. So just the small details which were given is as follows. Management issued a profit warning for the quarter ending September 30th, and the revenues are to be approximately 125 million. Now, for perspective, that's versus the consensus of 153 million, and it was actually 141 million in quarter 2, so this is going to be quarter 3. Operating income is approximately 8.4 million. For perspective, last quarter was 11.2 million, so there's a shrinkage quarter on quarter. Now, the reason is a more important thing. So management cites the disappointing results on basically same story but worse than expected. The US business, it's underperforming due to lower than expected demand for the soda makers and flavors, which were the primary drivers for the overall shortfall in the third quarter. So the story remains, the SodaStream product seems to be attractive, with a stable base in UK and is growing among Asian markets, but they just cannot conquer the US consumer. While establishing base of repeat users in the US, they have difficulty attracting new consumers. Well, so the management, to address this, the management states that they have started their strategic shift of brand towards health and wellness, and in addition, are developing a comprehensive growth plan for the company that will encompass marketing, product, and innovation. The details for this comprehensive growth plan will, they have said that they will announce it during the quarter 3 results itself. Okay, so now for some perspective, last quarter, management guided basically a minus 5% year-on-year net income contraction. Okay, but unless they can turn this weakness around in quarter 4, which is highly unlikely in the short term, we estimate that the contraction of net income is likely to be on the order of minus 25% to 45% rather than just 5%, unless they can dramatically change. So basically assuming similar numbers in quarter 3, because the issue here seems to be that a quick fix is not enough, because they cannot conquer the US consumer. So we think the weakness in quarter 3 will probably likely extend to quarter 4. So unless quarter 4 sharply improves, we can expect this sort of earnings contraction. Hence, because of lack of growth visibility for this year, FY14, we basically remain at neutral. We've been at neutral before, and so we continue to remain at neutral with the target price at $21 right now. Okay, due to the impaired earnings and lack of growth visibility, there may be some positives in FY15 and 16, but that is a little bit too far away to say anything. But for this year, there's definitely lack of growth visibility, and hence until further visibility, we remain neutral.
Good morning, clients. Joshua here. Okay, last week I released a short note on the corporate event of St. James doing a reverse takeover for Perennial Real Estate Holdings, and then after which Perennial Real Estate Holdings will make an offer for Perennial China Retail Trust. Right. So in this rather complicated transaction, at the end of the day, we find that there is some value to be had if you buy Perennial China Retail Trust. Okay, so let's just start with taking you through the transaction. So St. James, so RTO PREH, right? It's 1.56 billion acquisition, and issue new shares to the vendors of PREH at just over 2.6 cents. Okay, the shares would then be consolidated 50 to 1, which means the post-consolidation issue price is about 133.5. So the new entity will be renamed PREH. This will be done by I think the 27th of this month. So the EGM already approved this RTO, so this part is a done deal. Now PREH, after the whole the thing is after the RTO is over, will make a voluntary offer for PCRT, okay, which is a listed entity, as some of you know, has not had a very successful listing due to some of the assets underperforming. Okay, so part of the reason why this VO is happening is that the group wants to rehouse these assets back in the main entity, PREH, and therefore, in a sense, rescue minority shareholders at PCRT, okay, and bring them into a much larger entity. Now, so what does this transaction do? Basically, you swap one PCRT share for just over half of a new PREH share, price at 133. And that implies that PCRT units are priced at 70 cents. Now, the last done trading price of PCRT is 525 cents, 52.5 cents. Okay, and this implies that PCRT unit holders are actually now only paying 99 cents per share for this for this transaction. Now, so what are you getting for 99 cents? The resultant PREH, which has a pro forma NAV of 162. Okay, so that's already a huge 30% discount to the pro forma NAV. And now the RNAV is quite likely to be over $2, okay, if there's 100% acceptance. So this means that PCRT shareholders, unit holders, are going to be buying into this much larger developer at a 52% discount to RNAV. So the key question now is, are these underlying assets of PREH any good? So we think they are. Next slide. Now, if you look at the list of assets here, you can pull out the report I published last week for more details, right, if this is going too fast for you. Okay, so there's a very massive development in Beijing called the Beijing Tokyo Integrated Development. It's at a transport hub of major subway intersections and a bus interchange. This area is slated to be the second CBD of Beijing. Okay, so huge development of over 6.6 million GFA, and of which PREH will have an interest of 40% in phase 1 and 23% in phase 2. Now, there are other quite large developments. One is in Chengdu East High-Speed Rail Integrated Development. It has retail, office, and apartments. Over 8 million square feet of GFA, 50% interest, and basically the high-speed rail. There are 8 high-speed rail hubs in China, and so their development is right next to the high-speed rail. Again, excellent connectivity, also connected to the city subway line and buses as well. There's one more in Xi'an high-speed rail development, also an integrated development of retail, office, apartments, and hotels. Almost 7 million GFA, right? 51% interest, okay? And also in Chengdu, there is this rather large mall from which they have a 80% interest and 3 million square feet of land. And there is one troubled asset, which is basically Shenyang Red Star Laundromont and offices. And these were in PCRT and will now be rehoused back in PREH. So in a way, if you're stuck with PCRT shares, it would be, I think it would make sense to accept the offer and to be housed in a much larger entity. Okay, so in Singapore, they own 51% of Chimes, over 50% of 111, and 50% of Capital Singapore. Okay, so if you add up all these new developments. Actually, there is a net asset value contribution of almost 800 mil, and if you divide it by the total outstanding shares post RTO, post VO, right? Basically, you're looking at almost 50 cents worth of NAV accretion, right? And so if you add that on to the historical pro forma of 162, you're going to get about 212. So PCRT shares right now with an implied value of 99 cents. If you buy it at 52 half, okay, the implied value will be 99, which would be more than 50% discount to the RNAV of PREH. Okay, so we think it's good value to be had. This is a little map here that shows you the high-speed rail network in China. The dotted lines are the lines that will be constructed. So if you can see, Chengdu is directly connected to Shanghai, and Xi'an, Shenyang are all in high-speed rail networks as well. Okay, so the two developments that are actually right next to the high-speed rail station would be this one in Chengdu and the one here in Xi'an. Okay. Okay, so you'll be getting all those assets at a steep discount, and the partners, rather the sponsors, sorry, are very reputed individuals. 35% of PREH will be owned by Mr. Kwok and his related parties. Ron Sim of OSIM, 12.5%. Wilma will have 10%, and Posek Guan was the pioneer of REITs and the ex-Capital Malls Trust and ex-CMA CEO. Okay, he'll own about 10.56. So the free float of the resultant entity would be actually about 32%, with the parties here owning, I think, 68. Okay, pass you over to Benjamin, who will talk about the offshore marine sector.
Hi, very good morning to everybody. Benjamin here. Right, in our past webinars and morning calls and coverage over the last 1 year, you might have come across my name, and usually I'll be presenting on the banking sector. So our previous offshore and marine analyst has left about half a year ago, so I'll be taking over the offshore marine sector. So a quick refresh for the coverage under our research team. We have Keppel and Sembcorp, which will be taken over by me, and then we have Ezion and Ezra, which will be taken over by Sam, who presented earlier on the India macro. Right, so since that this is my first webinar on the offshore and marine, which is O&M for short, right, thought it'd be quite appropriate for me to bring you through some of the basic terms that we use for the offshore drilling industry, so that we can be more familiar, right, with all the common terms that we use, and subsequently I'll move on to outlook on the offshore and marine sector, which the last update was about half a year ago. So I think now is quite a good timing, considering there's quite a lot of movement for the counters within the O&M sector. Right. So first up, the offshore marine industry revolves around the drilling and production of oil in offshore oil fields. So definitely one of the key assets that we'll be using will be our drilling rigs. Right. So there are a few types of drilling rigs that we can choose from depending on a number of factors, right, such as water depth, seabed conditions, weather conditions, the operational safety requirements that are needed, the efficiency of the rigs, right, weather conditions, and of course the cost of using the rigs. Right, so these are some of the main factors that we'll be looking at when the drill operators choose which type of rigs to use. So in terms of the different types of drilling rigs, there are two main categories. First up will be the jackups, right, which might sound familiar to some of you. And then we have the floater section as well, right, which consists of the semi-submersibles, or semi-sub for short, and drill ships. Right, so for jackups, these oil rigs are towed out to the drilling area, and there'll be leg columns that can be lowered onto the seabed floor, right, and the drilling platform can be jacked up and down, hence the name. Right, so jackups usually operate in shallow water depths. Right, for floater section, right, we have our semi-subs and drill ships, so they operate in mid-water to ultra-deep water conditions. So for semi-subs, is a platform that is secured on top of columns and connected to pontoons. So pontoons is something that's below the semi-sub. You can pump water in and out to adjust the submersibility of the semi-sub. So semi-subs, because of that, they are extremely stable when they're held in position by large anchors. Right, so some of the newer ones actually have additional dynamic positioning systems in place. So these are computer-controlled systems where the thrusters under the semi-subs can be adjusted and tuned by the system to balance itself in weather and wave conditions by using a satellite. So semi-subs are extremely good for harsh water conditions like the North Sea and deep water conditions. Right, drill ships is basically a drill rig on top of a ship. Right, so because of that, it's the most mobile drilling unit compared to semi-subs and jackups. Right, so drill ships can operate in very remote and ultra deep water conditions. Right, so I think a diagram will give us a better flavor of how all these actually look like. So we look at the jackups. These are the leg columns that are lowered onto the seabed floor, right? And the platforms can be moved, jacked up and down. And this is the cantilever, right, where the drill bit goes into the seabed floor. Right, for semi-subs, this is the platform, right, where the drill column goes through the middle, and the drill bit will go into the seabed floor again to drill the oil well. And these are the various anchor lines that will hold the semi-subs in place. Alright, for drill ships, shaped like a ship, and there's a moon pool in the middle, which is basically a hole where the drill bit can go through the ship, right? So it can operate in ultra deep water conditions. Right, so this is one of the most popular jackup designs in the world, the KFL's B-class jackup by Keppel Yard. Right, so you can see the columns are the legs, the jackup legs, and this is the drilling platform. Right, so this is one of the photos that we took when we went for a project that was managed by Kim Heng. So this is a very old design of a semi-sub, but basically the look of it is about the same as the modern day one. So this is owned by Transocean. This is the drilling column. And the pontoon is actually below the sea level. That's why we can't see it. Right, moving on. So this is a drill ship designed by Sembcorp Marine, the Jurong Espadon design. So SETI Brazil and Transocean has ordered quite a few of these drill ships from Sembcorp. Right. So I hope that all the photos and explanations have helped us to gain a better understanding of the different drill rigs that we use. Right, so again, jackups are used for shallow water, and the floaters, which are your semi-subs and drill ships, are used for mid to deep water. Right, so these are some of the very common assets that we use in the O&M industry, which we might come across when we mention about different counters. Right, so for the offshore support vessels, which is OSV for short, some of the common ones are AHTS, right, which is anchor handling tug supply vessels. So besides being able to tow boats, right, these very versatile vessels are able to do anchor handling and provide supplies as well to platforms and oil rigs. So some of these, interestingly, some of these AHTS is used for search and rescue missions as well. Right, so the Australian government actually used one of the deep water harsh condition AHTS from VAT, right, to be involved in the search for the MH370, right, over the Indian Ocean, South Indian Ocean. Another one would be a platform supply vessel, and FPSO, which is a floating production storage and offloading. This term might seem familiar to some of you as well. So basically, it's a tanker that has production capabilities, right? Seismic survey vessels, diving support vessels, which are used for subsea work, comms vessels. This is what Porsche has a niche in. Then we have pipe laying and leaf boats, which is what Ezion is involved in, and Triads built the leaf boats. Right. So moving on, I will talk on the brief outlook for the offshore drilling industry. So today, there will be two main parts to this. First will be on the jackup market, and second will be on the floater market. Right, so the question that a lot of people have been posing is that, are we seeing an oversupply of jackup in the market? Okay, so we refer to the chart over here on the rig orders over the last few years. Right, so the order boom is quite evident from 2011 to 2013. Right, but year-to-date orders is also quite obvious that rig order momentum has slowed down quite significantly. Right, and over the last 2 years, orders have been largely concentrated in the jackup market, right, illustrated by the blue portion over here. Deep water floater orders, which is your semi-subs and drill ships, has slowed down quite significantly as well, right? And I will touch on this later in the second section, which I did when we discuss about the deep water section. Right? if I refer you to the two bottom charts over here, right, the day rates and the utilization rates for jackups appear to be holding up quite well. Right, I'll dive into more detail on that later on. Now we take a look into the future deliveries of all these accumulated orders for jackups that we have seen in the previous slide. Okay, so over here, this is a display of all the jackups that will be coming into the market from this year onwards. As you can see, the jackup deliveries will be peaking from 2015 to 2016. Alright, if I refer you to the bottom right chart over here, alright, this is how the flow works. Rig builders, which are yachts, like Keppel and Sembcorp in Singapore, we have our Korean yachts, China yachts as well. Rig operators or owners, they will order and buy oil rigs from the yachts. Right, integrated oil companies, national oil companies, they award drilling contracts to the rig operators and owners. So supply comes from here, and demand comes from here. Alright, so we refer back to the first chart. With a boom in the deliveries going forward, a shockingly large percentage and proportion of the new builds coming in do not even have a contract yet. Alright, if you refer to the chart over here, right, 11% of the new builds coming in, only 11% are contracted and ordered by established drillers. On the other hand, more than 50%, right, of the new builds coming in are uncontracted and ordered by non-established drillers, meaning these are speculative orders. So it's no wonder that there's a concern on the jackup market. Right, but today, in our view, things are not as bad as it seems here. So in fact, we believe that demand for certain types of jackups are still there and still strong. So I'll show you our arguments for that in the next few slides. Right, one big reason for us believing that there's no need to be too concerned on the jackup market is that because of the aging jackup fleet. So over here, you can see that almost 50% of the global jackups are more than 30 years old. Right, if you look at the bottom chart over here, ever since the last building boom of jackups in the 1980s, all these jackups being built in this era have a lifespan of about 30 years. Right, and this is the effect if all the jackups older than 40 years exit the market. Alright, because all these jackups are already near 30 years or more than 30 years, they are becoming less competitive, becoming more obsolete, and because of this, it's an incentive for the rig owners to replace them and retire them. Okay, so on top of that, right, from what we understand, when rigs reach 35 years of age, they are also required to complete a regulatory survey to meet classification requirements. And a lot of capex needs to be spent by the rig operators, right, to keep all these old rigs certified to be working efficiently and safely. Right, this is even more so for rigs that have not been well maintained across their useful lives. Therefore, all these cost prohibitions is another catalyst for the rig owners to retire these old and uncompetitive rigs. The second main reason for us believing there's little concern for oversupply of jackups is that we believe there continues to be demand for high specification jackups, which usually is determined by the water depths that the jackups can operate in. So for the high spec jackups, they usually can operate in 350 feet or more of water depth. Right. So let's examine the utilization rates and jackup rates, and day rates for the various classes of jackups. So if you look over here, this chart, if I refer you here, we look at the blue line over here. This is the utilization rate for high spec jackups, right, which is more than 350 feet. It's evident that utilization rates for the higher spec jackups, right, is much higher than the lower spec ones. And then if we look at the day rates, it becomes even more evident. Right, jackups, the high spec jackups command much higher day rates in today's context as compared to about 10 years ago. Right, there were not much difference. Right, so high spec jackups command a much higher premium than low spec ones. Right, so what does this mean? Right, the low spec jackups, if they have lower deployment rates and day rates, this is another incentive for the rig owners to retire or cold stack all these rigs and eventually replace them as well, because the lower spec jackups are also usually the ones that are older. Right, so if you look at the split between the high spec and low spec jackup in today's context, right, 15% of the global fleet, only 15% are high spec, and the rest are considered low spec, right, because of the operational water depth. Right, with the new builds coming in over here in this chart, only about 80 are high spec rigs, right, so definitely this 80 that are coming in is not going to be enough to replace the demand that's in place, right, to replace all these low spec as well as older type of rigs. Right? So therefore, this is how we reach our conclusion that there's a bit of an over-worry on the supply issue. But definitely, again, at first glance, the boom of deliveries in jackups, coupled with majority of the new builds coming in, they're not being contracted. Yes, there appears to be some form of downside risk to the order momentum that will come in. But on top of that, more than 50% of new builds are also uncontracted and speculative in nature. So again, the argument against that is that, remember, close to half the global jackup fleet is more than 30 years old, right? So they are less competitive. High-spec jackups, they enjoy high utilization rates and day rates, right? So incentive to retire the low-spec jackups. About 1/3 of the new builds are also a low-spec, and only 15% of the current jackup fleet is high-spec. Alright, so therefore we believe that all these are drivers for jackup replacements across the global fleet and demand for high-spec jackups, which means jackups that are built by our Singapore yards, Keppel and Sembcorp, should continue to remain firm. Now I'll move on to the second section of the deep water side, which will be a discussion centered around our belief that there's a weakness in the deep water segment, which is the floater segment, by your semi-subs and drill ships. So this was presented also earlier on this year, right? There's a bit of pressure on integrated oil companies to return cash to their shareholders and tighten their capex as well, because the return on capitals for them have declined. Right, as a result of that, there's quite a bit of pullback in contracting of floaters, right, your semi-subs and drill ships. And also recently, for the last few months, with the recent drop in the oil prices, right, it's also a downside risk to exploration and production spending growth. Right, consequently, this is going to affect the deep water segment because it's costlier to produce oil in the deep water segment. Okay, I mentioned earlier on the section of jackups, you're currently in the midst of a boom, right, in delivery of oil rigs, right? But we know that the floater order momentum has slowed down quite a bit. If you refer here to the chart that I flashed earlier, if you compare 2013 and 2014 to the last few years, right? Yeah, semi-sub orders have been really quite little, right, illustrated by the red bar. Alright, and drill ship orders have slowed down quite significantly as well. And I refer you to the bottom left chart over here, which I also built for the jackup segment. Right, it's quite evident that the deep water market is oversupplied for 2014 onwards. Right, so you can see more than half of the new builds coming in are not contracted yet. And this continues to put pressure on the day rates for the floater segment and utilization rates as well. And if you look at over here, these two charts, the drill ships and semi-subs, the utilization rates are really dropping. So at first glance, the day rates appear, right, to be quite firm. But I'll break that down for you in the next slide. Okay, so day rates for floaters are bifurcating between the older floaters and younger floaters. If I refer you to the chart over here, you can see that for the younger floaters, they command much higher day rates than the older ones. Alright, and deep water day rates are also starting to trend down. Right, if you look over here, there's a breakdown of the different water depths for both semi-subs and drill ships. So deep water is around the 5,000 to 8,000 feet of water depth. Right, it's been starting to show downtrends. So our concern over the deep water market is also reflected in the various drill rig operators and owners, right, which they mentioned quite recently in their earnings announcement. Right, so for ENSCO, they mentioned that it's hard to predict the length and depth for the current downturn in the floater market. Right, two main reasons: supply of new rigs coming into the markets, decline of tender inquiries. So this disrupts the balance of supply and demand. Noble is seeing a cancellation of a few projects, creating some uncertainty. And for Seadrill, they believe the market continues to be challenging. Right, so like I mentioned before that, a cut in the capex E&P spending. Right, we see that in the reduction of exploration drilling. Right, on top of that, the older units, right, requiring renewal is driving down prices in the short term, okay, which is driving down your day rates. Right, I'll come on to this. As you already know, oil prices have been slipping quite a bit in the recent months. Right, so earlier this year, everyone was pretty happy, satisfied that the oil prices were comfortably above $100 per barrel. Right, but now it's really slipped into the $80+ per barrel region. Right, so if you look at the top chart over here, right, this is the cost of producing oil in various segments. Right, so for the deep water and ultra deep water, the cost of producing oil is higher, much higher than that of producing it in shallow water, which is the offshore shelf region. Right, needless to say, onshore is the cheapest. Right, so it culminated together the fact that oil prices are falling, right, and doesn't seem any sign of coming up anytime soon. Right, this does not bode well for the deep water and ultra deep water segment. Okay. So of course we need to know what this means for our two Singapore yards. You can see China has been driving the growth, right, in the global fleet supply over the last 2 years. But remember that many of the new builds from the China yards are of speculative building in nature and are not of high specifications. Our Singapore yards, on the other hand, they build only high spec rigs. Right, China yards are also prone to delays and they have very limited experience and track record in rig building. So a quick examine on the order books, right, for both Keppel and Sembcorp. Right, Keppel's order book is largely dominated by the jackup segment, when for Sembcorp the exposure to drill ship is much higher. Right, so Keppel's exposure to shallow water is more, Sembcorp is more exposed to the deep water side. So as a result of that, I think Sembcorp seems to be a bit more under pressure on winning orders going forward. But that being said, they recently today just announced a win of an FPSO conversion, right? But this is something that's on the conversion side. So last up, right, in our conclusion, right, this is the value chain for the offshore drilling side. Right, for the exploration phase, this is where the risk is, as it's largely capex heavy. So we will advise, to underweight any companies that are exposed to this segment. We're facing quite a lot of sell down pressure on companies that are exposed here. Alright, so for the development and production phase, this usually takes about 20-30 years, right, once the oil well is up. So this part is less affected by the shock in oil prices. Right, the last phase will be the restoration. So companies that will be here are usually integrated oil companies, national oil companies, contracted rig owners for exploration drilling. Right. Then moving on to the development and production phase, this is where the rig owners, oil field services players are. Right, so throughout the life cycle, we support players like repair, maintenance, OSV, which is your offshore support vessel, charterers and operators, and oil field services. Right, all these will always be needed, right, during the production phase, right, or throughout the entire life cycle to support them. Right. So I'll end off with the current calls that we have. So for Keppel is still neutral, Sembcorp Marine last call was reduced, Ezion accumulate, Ezra neutral, and Kim Hing is still on the buy. So I think some of the counters that we can be more selective on a bottoms up approach, considering that there's quite a bit of heat on the O&M sector. Right, we prefer companies to be with exposure to shallow water, right, and they have their own niche. So companies like Pacific Radiance and Nam Chong, they are exposed to the offshore support vessel side in the production stage, right? So Pac Radiance, their OSV charterer, Nam Chong is a build to stock model of OSV builders, and both of these operate in protected markets like Malaysia, Indonesia, right? Porsche usually operates in mid to deep water, right? However, they have forayed into the accommodation vessel side, which I think is quite lucrative. And then we have Triads as well and Ezion, right, which are involved in the leaf boat segment, where demand for leaf boats in the Asian market continues to be very healthy. And remember that leaf boats are more of an oil field services support sector, right, which is required throughout the life cycle, being during the production or even during the restoration of and stripping down, decommissioning of oil drilling platforms. Right, so with that, I'll end off the presentation today, and please feel free to start asking questions.
Hi, we have a few questions on PCRT. PCRT-wise, the initial issue to vendors value at a low price and then consolidate the shares again. Simplest is that basically St. James is it's not cash out, sorry. It's you value the listing status at about 10 mil, and since you're bringing about 1.5 over billion worth of NAV, you're going to be diluted 99.9% or something like that. Okay, this is why they have to issue enough shares that values both parties fairly. So St. James 10 mil, whereas PREH is a giant, right? So 10 mil out of a few, 1 point something, 1.5 billion. I mean, you do the math, right? So that's why you issue billions and billions of shares at 0.267, okay? And then that means that the vendors will overwhelmingly own St. James, and then you consolidate what is a penny price stock to by 50 to 1 to bring the price to over $1. Okay, so it's not in the interest of a company to actually have its price at such a low price. I mean, they could easily say that, oh yeah, we'll just leave it at 50 over billion shares and trade at 2 over cents, but basically no institution will be interested in you anymore with that kind of price. Okay. What's the likelihood of the voluntary offer of PCRT going through? I think it's very high, because the alternative is that of staying PCRT the way it is that you basically have inferior assets to the PREH. Okay, PREH has definitely much superior assets to PCRT, and also you are getting the PREH assets at 52% discount to RNAV, whereas right now, if you look at the valuation of PCRT, it's only about 30% discount. So you'd probably want to trade up to deeper value. A question here, PREH does not seem to be listed. That's the exact point. It's not a listed company. It is a reverse listing. Okay. PCRT, once it will be absorbed into PREH, will no longer be, and instead you will get PREH shares.
Hi. Answer quite a number of questions. Right. First of all, there's one question on the oil price level of crude oil. How will it jeopardize the replacement of jackups and other types of oil rigs, and what oil price level would that happen? I think for that, if I understand correctly, jeopardizing means slowing down the replacement rate of jackup rigs. That will happen if the oil prices are sustainably very high, because high oil prices means that there's more incentive to pursue certain types of production, like enhanced oil recoveries, right? So for that, usually they like to use older types of rigs, right, to perform this kind of exploration and oil recoveries, right? So on top of that, some of the companies, usually a rough benchmark they use is that anything that drops below $80 per barrel, that becomes quite uncomfortable for production of oil, right? But for replacement wise, it's more like if the oil prices are too high, right, it actually slows down the replacement needs for jackup rigs, right? And then for a question on reason for a strong drop in price of tech radiance. But yeah, tech radiance price has dropped quite significantly, but I think this more of a lot of funds pulling out of tech radiance, right? Generally, a lot of funds are underweighting all the counters in the O&M sector, right? But for us, we believe that as long as it can be selective from a bottoms-up approach, there are still good opportunities to be found. Right, next up, can I conclude that you are negative on oil exploration companies, example, Chris Energy? Currently, we don't cover, Chris Energy. Haven't really taken a look into that, right? But again, on a whole, we have less preference for companies that are involved in the earlier segment, right, the upstream segment, during the exploration phase. Right, high USD will impact more on which O&M counters. There are quite a lot of O&M counters that actually denominated in USD, like Ezion. So high USD will definitely positively benefit such companies. For example, like Ezion. Right. Alright, there's one on what counters to look out for, and now we recommend this. Right, for us, we don't have a currently don't have a rating as we are not fully covering the companies have been recommended like Pac Radiance, Namchong, Porsche, and Triads, right? So for us, we don't give a firm rating of them. But that being said, I did mention that we are more overweighting on companies that are exposed throughout the entire life cycle, as well as in the support sector. Right? So these are the companies that I think will be quite worth accumulating, by considering the prices are correcting so much. Right? How will the latest FPSO contract win for Semcom Marine impact the company's value? Right, will be quite marginal considering that their current order book is about 14B. Right, currently the new order win is about 690 plus USD. Right, so in Sing dollars, it's close to about 1 billion. Right, so not that much of an impact currently. Right, and Semcor is facing quite a lot of short selling pressure as we have seen over the last few weeks. Right. Oil prices are dropping, right, largely because of an oversupply issue, and OPEC seem to be wanting to cut production, right? And of course, there's a lot of short selling on the oil sectors, right? So the oil prices have been coming down quite a bit, right? And how long it will go for, we don't have a definite answer for now, but doesn't seem to have any signs of popping up anytime soon, right? Kim Heng is let me check on that for you. My question
Yep. So the capping of gearing at 45%, how will it affect the REIT sector? Actually, this part of the ruling may not affect that many, because it's quite likely that a REIT will want to gear that high anyway. For CRT, is a business trust and is not affected. That is true. It is not a REIT, so it doesn't have that gearing cap.
The symbol for Kim Heng is 5G2, to a question out there. And then the last target price for Cable Corp is $11.35, and Semcorp is $3.70. Right, but I think that will be reviewed in the upcoming result season. Yeah, thanks for that on the offshore drilling side. I think possibly, yeah, in the future we might look at the onshore drilling side as well. But given the context of Singapore, most of the companies here are more exposed to the offshore drilling side. Yeah, so that's why more focus is put on this. And then on top of that, the supporting services that we have is quite vast in Singapore. Hence, that's why I'll focus on the offshore side, where we have plenty of counters to select from for OSV charterers and operators, right, or service providers. We have a question on what's the average cycle till the next uptick for a company like Semcom Marine. I think on a general side, we have to monitor the macro conditions as a whole. Right, for that, currently the O&M sector cycle is going on a downtrend. Right, so probably have to wait until the deep water pressure is off first, and the so-called oversupply issue for jackup wears over. Right. So normally, this usually takes a couple of years, right, for that to blow over, right? But of course, in the long run wise, deep water is still the way to go, because most of the offshore discoveries that we are seeing are still in deep water pockets, right, rather than on the onshore side and on the shallow water side, right? But currently, of course, offshore is the cheapest to produce shallow water is obviously the cheapest to produce for offshore drilling. Right, yeah. There's a question on, are there any key investment merits on keeping as a buy? Company not too long ago issued a profit warning. But the profit warning that was issued last quarter, right, if you remember, was because of a delay of the rigs that were coming into the Singapore waters for them to service. So from what we understood previously, right, I think a couple of the rigs have already come into the Singapore waters for them to service. So for this quarter, I believe that the profit line should be higher quarter on quarter as compared to the last one. All right, and the order book, I would say order book, it's more like the commitments that they have from their customers continues to be quite strong, right? I think it's about 40 plus million from what I remember the last time, right? And Kim itself is more exposed to the repair and it's more on the repair and maintenance side, right, for oil rigs. So I think that a lot of the rigs are also aging, right? This is where Kim come in, right, to perform all this kind of service and maintenance work, right? So Kim itself is not so exposed as compared to companies that are in the capex sector, which is more upstream. Right, and Kim itself is also looking to acquire some subsea services player, right, to complement its suite of services. So this is one of the earnings kicker that will come in later on. Thanks for tuning in today to our weekly webinar, and I look forward to seeing you again and hearing from you guys next week. Right, thank you very much.